I am of the view that something important happened around the year 2020 and 21, those 2 years. And I believe what happened was the end of a 40-year bond bull market. And I speculate the beginning of a bond bear market, which on form is likely to run not for fiscal quarters or years, but perhaps for decades.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When today's guest was last on this program back in June, he predicted that interest rates would remain higher for longer. And the ensuing 7 months proved him correct. With inflation remaining stubbornly sticky, new tariffs and other disruptive policies announced by the Trump administration, trillions of dollars in US Treasury debt to mature this year, and the return of the bond vigilantes, where are interest rates most likely to head from here? To find out, we've got the great fortune of speaking today with perhaps the world's foremost living expert on interest rates, James Grant, founder and editor of the highly respected market journal, Grant's Interest Rate Observer. Jim, thanks so much for joining us today.
Well, thank you, Adam, and thank you for that extravagant introduction. I want to just own this title of interest rate guru. I'm an authority on where interest rates are, and I am competitive on the question of where they have been. As to where they're going, it's a whole new ball game.
It's a toss-up, is what you're saying? Well, let's throw the ball in the air and let's see where you tip it.
Okay.
All right. So lots of questions for you, and we're talking actually at a very timely moment. We just got new inflation data that just came out this morning that hotter than Wall Street clearly wanted. We'll talk about that in just a second, but if we can, Jim, I'd like to kick this conversation off with the opening question I usually ask our guests. What's your current assessment of the global economy and financial markets?
Well, I am the kind of guest who's not going to answer that, Adam, because I wasn't born yesterday. It's so amorphous. The global economy is just bigger than all outdoors. I think I'm reminded of Charles de Gaulle when he was asked about, I think, China from India. And he said, big country, lots of people. So I can venture the comment that with Donald J. Trump in the White House, things are most interesting. And I think there are interesting currents having to do with the dollar, the nature of the dollar,
Okay.
and the place of America in the world's monetary system. So that's as global as I care to be on this. It's a worthy question to which I have no worthy answer. I took 5 minutes in saying I don't know. I'm going to try to be more efficient from now on.
Don't worry. Yeah, I like how you zig when I thought you were going to zag, but don't worry. I'm still going to run the pattern, and I think we're still going to get the football in your hands here. We're also going to see how many sports analogies I can come up with during this interview. Okay, well, look, I want to go into all those things, the dollar, your thoughts on the new Trump policies, et cetera. But why don't we start with inflation? So the morning we're talking here, like I said, I think the CPI came in. I only had a chance to skim the headlines, but it looks like the CPI came in at 3.0. I think the expectations were 2.9. There's enough data in there to make the market feel like this is stickier than we had hoped. Markets are down, at least at the open here. Like I said in the intro, when you and I talked 7 months ago, you had correctly said, look, I think inflation is going to prove stickier than folks want, and I think that's going to keep interest rates higher than folks want. That seems to have been the script so far. As you continue to look out, and I won't make you look out too far, but kind of rest of the year-ish or so, are you still kind of thinking it's going to be higher and stickier for longer?
So by way of preface, I am of the view that something important happened around the year 2020 and 21, those 2 years. And I believe what happened was the end of a 40-year bond bull market. And I speculate the beginning of of a bond bear market, which on form is likely to run not for fiscal quarters or years, but perhaps for decades. That's the form. Since the middle of the 19th century, interest rates have tended to trend in generation length phases. It was 35 years down from 1946 to 81, I guess about 35 years, and then down in price, up in yield, the bond bear market beginning in 1946, and then the magnificent bond bull market beginning in 1981 from the heights of 15% on long treasuries to less than 2% in the treasury, and worldwide something like 17 trillion were quoted at less than 0% in nominal yield. So it's an extraordinary run in bonds. And so anyway, I think that's to me, just examining the historical data and doing nothing more than projecting historical tendencies, not laws, but tendencies or observed trends. I think that is the background. Now, in the foreground, I think that inflation is kind of the spirit of this time of ours. There's a kind of a spirit of overdoing it, and the government, not just a kind of, there is a great excess in the government spending and borrowing, and the Trump people have promised to do something about that. But as things stand, we are running a deficit, of 6.5 or so, 7% in a time of pretty good growth, and lots of debt, and lots of animal spirits thanks to the election. And I'm thinking that inflation will in fact persist. Now, as to an example of how on a micro level this could be so, consider the component of inflation calculation of the CPI that counts for about 36 or 37%. That is imputed housing rental costs, the cost of shelter. And over the past 5 years, the government has computed that as something like 26, 27% up, whereas Zillow out there in the private sector counts it as something like 40%. And we think that Zillow is likely to be closer to the mark. Therefore, there is that pocket of important strength within the CPI that is likely to continue to work, pushing measured inflation to the upside. And so I think then, to sum up, I think in a very speculative vein, I think that we might be in for higher for much, much, much longer if the historical past is prolonged. And this inflation print this morning is, I think, something that we're going to have to get used to. I don't see anything really that is going to reverse it.
Okay. So if you don't like inflation, if you don't like sticky inflation, the beatings are likely to continue until morale improves. Let me ask you this then, Jim. So the Fed pivoted policy last year. We've had 100+ basis points of rate cuts since then. They started with kind of a big bang, right, with a 50 basis point cut. Did the Fed make a policy error by cutting too early?
I thought that was ill-advised. I bet that Jerome Powell is heartily sick of hearing free advice from the sidelines in that 50 basis point cut, but I dare say it was ill-advised. And here I am borrowing from remarks that Stan Druckenmiller presented at our fall conference. We have one a year or two a year now. And he said it was a case of poor risk management, which I thought was a good observation. They didn't take account of the Fed didn't take account of the possibility of a of a Trump election and a great big hurrah. Um, apropos of animal spirits, I happened to be shopping for my wife of 52 years and counting,
Wow,
Bergdorf,
congratulations.
a while ago. And one of the salespeople told me that the morning after the election, the queue of shoppers to get into this kind of fancy department store was around the block. When she showed up for work, she had never seen the likes of it and thought perhaps it was some public safety event. Um, but that so the Fed didn't anticipate that there could be anything like that, and so I think 50 basis points was too much.
Okay. First off, congratulations again. I'm the inverse with my wife with you. We're at 25. We have our 25th anniversary this year.
Oh, done.
Thank you. And
It's
I
a
know what it
start,
takes
Adam.
to I know what it takes to get to 25, and it's a lot. And you're more than double me, so kudos to you. Um, I'm going to ask you to speculate just here for a second, and feel free to dodge the pitch if you want. But uh, there's some speculation that the Fed, while supposed to be independent, was, kind of kind of on the team of the current administration, trying to help, juice things leading up to a presidential election. Do you think that played a factor, or do you think that that's just,
No, two thoughts on this. I think it's a matter of fact that the Fed politically is less leaning to judge by the contributions to political candidates, which people have tallied up, and it's highly skewed towards the Democratic Party. I thought that prejudice came out sadly when Judy Shelton was nominated to the Federal Reserve Board some years ago. It was 2000, sometime during the first Trump term. And she stands for sound currency and at least some remonetization of gold and dollar back into the world of classically anchored money. And she would, to be sure, have been irritant to those who welcome monoculture. For example, President Trump welcomes monoculture, and the Fed does too. Eccleston. And it was clear the Fed wanted no part of this outsider with these peculiar ideas about the nature of money, and it made no secret of it to its friends in Congress. In fact, so I think so. Yes and no. I don't think the Fed was actually cutting 50 basis points to Harris, or impute motives that perhaps are not there to tell. I think institutionally the Fed would certainly have been happier with Kamala Harris. No question about that.
All right, Jim. It really interesting. I'm resisting drilling further down that path, but for the time being, I'm going to. All right. So you've said that you think interest rates are going to continue higher for perhaps much, much, much longer than folks realize here. So what are the implications of that kind of world?
Well, the if you ask what is the average American interest rate? Okay, since the founding of the country, 1790, call it. What is an average rate? And that average rate in investment grade securities and railroad securities, corporate, 5%, 6%, over there. So government securities, not so far from that. So the rates we have had for many years leading up to the present day were much lower. I mean, 10-year yield of 1% or less, federal funds rate at 0. These things condition people to really to live in a world without a cost of capital.
Mm-hmm.
That would have been a kind of a nice thing to perpetuate forever, but it came to a close as so many false things do, so many good things do, actually. So we are back to, I think, still somewhat shy of what one might regard as an average American interest rate. And that's one thought. The other thought is that as we approach this average American rate, a lot of balance sheets that were built on the expectation of much lower rates, a lot of these balance sheets will need kind of remodeling, right? You're going to have to raise equity, reorganize the company, because even companies that borrow, for example, at these low rates prior to 2021, these loans will fall due and must be rolled over, and typically the rollover rate will be shockingly higher than the incumbent rate. Therefore, we're going to see bumps in the road as companies and indeed governments, state, local, federal, encounter rollover risk if these rates persist as they are or move higher. You'll see that risk manifested, for example, the real estate market. There was a very fine building that used to be called the Pan Am building, and now it's the MetLife building in New York City. It is just uptown from Grand Central Station. And
I used to live near it. Yeah, know it well.
Yeah, it's a lovely place. And the building was, I've forgotten the precise numbers, but loan came up for renewal and they had to be refinanced at double the rate at which it was originally priced. So it's kind of a shock, and the shock waves will roll through many sectors of the economy: regional banks, real estate developers, private equity, for example, had flourished in a time of negligible nominal interest rates, and stock valuations, to be, of course, are predicated to some degree on interest rates and the expectation for future rates. And as the world adjusts to a world, I'm speculating now, of higher for much, much longer, we might expect new pressure to the downside on stocks which are valued at very fancy multiples of earnings. But there are a lot of upsides as well. I mean, the savers, for example, the poor saver has been cut out from these discussions of high finance and private equity and financialization all these years. How about showing up at the bank and the money market fund and for not doing much work, earning 4% and 5% and 6%? That's kind of nice. So savers are going to be empowered in a way they had not been. And there's a little noted but perhaps soon to be recognized feature of a bond bear market, and that is that you get to reinvest your coupon income at higher rates rather than at the lower rates that are characteristic of a bond bull market. So rates are going up, and you get coupon. Well, you invest that coupon not at say 2%, but at 3.5%. It's good. And so there's a little silver lining. But I think we'll get, and also, Adam, there's no telling it the tempo of my highly speculative projected bond bear market. The last one, 1946 to 81, it took 10 years to get from 2.25% to 3.25% on the long-dated Treasury. 10 years, 1 percentage point higher. Now we've already come out of the gates at a much faster rate than that, but things could slow down. So a lot of the tension that I am expecting in various segments of the economy, banking, real estate, private equity, the degree of that tension will depend upon the pace at which rates continue to rise, if indeed that is the script. So A lot as a friend of mine used to say, man, there's a lot we don't know. Yep, to be sure.
All right, well, thank you. But you're doing a good job of identifying, where the uncertainty lies versus where it doesn't. In other words, if we are indeed in a new multi-decade bear bond bear market, the things that you've outlaid for us here, hits to corporate balance sheets, a depression of today's lofty valuation ratios, benefits for savers, things like that. Those are sort of the known nodes, right? Those are sort of the trends we can have confidence in. It's really more about the timing and the scale of the interest rate change, and that's what we know less, and that's why people like you are exceptionally valuable during these periods of time because you're the one, you're like the sportscaster up in the skybox, just calling the action on the field as you see it unfold.
Yeah. Well, as for that image, Adam, I'm reminded of a New Yorker cartoon many years ago, and it features a great big football stadium and two guys up in the press box. And there's nobody in the field. There's nobody in the stands. And one sportscaster says to the other, well, let's take a look at the old schedule. So timing, of course, is essential. You don't want to show up for the game 3 years early.
Right, you want to make sure you're there when it's actually game day. Well, look, we do know some elements of this story, though. Okay, so we know that a lot of corporate America has is sitting on low-cost debt that it took out back in 20. Once it saw the Fed was starting to hike interest rates, it did the rational thing and said, well, let's lock in as much low-cost debt as we can. So increasingly, that's coming up for maturity, and I think that there is, trillions, if I'm remembering the stats I've seen, that is coming due for re-rating over the next year or two. On the private sector, there's a lot. It's a much bigger number, I think, that's coming up for maturity just in US Treasury debt. So we're entering this, at least some part of this phase, in the relatively here and now. So I guess where I'm going with this is, what I hear you say is just basically just math. Hey, everybody, cost of capital is getting more expensive. And mathematically, things need to happen around that, right? You discount cash flow models would, their future value, the present value, it gets decreased because you're increasing the discount factor, right? I know you don't know things for sure, but like as you look across the next year or two, do you think we're going to see some manifestation of this like increased gravitational force pulling down markets and whatnot, simply because we've moved so far so fast? People are moving from this, the very low cost world to at least today's world as these things start to re-rate.
A lot of possibility for elated recognition of a sea change in the cost of capital. And the Fed cut its 50 basis points and 25 basis points in the context of a $2 trillion market cap for Bitcoin, almost $1 trillion worth of market cap for other departments of the shadow banking business and meme coins, and including the president's own meme coin, launched rather tastelessly on the very eve of his inauguration. And we'll get back to that in a second. And rates have supported all manner of speculative goings on, and one would expect fewer of those in a world of higher rates, in a world in which people have come to decide those rates will not vanish because the Fed wants to make them go away. And I think one particular area of potential risk is a reassessment of the creditworthiness of the United States government. So Hamilton would use the phrase "the public credit," and that was a phrase you heard off and on, mostly on, from his time through the 19th century and the 20th. But mostly, people have stopped saying that. Really, People have come to, I think people have come to assume, not I say people, I think people everywhere have come to assume the United States is the permanent holder of this dubious gift of the reserve currency franchise that can borrow as much as it wants for as long as it wants on the terms that it chooses. And uh, what if that were not the case? What uh, if the market decided, gradually that, gee, the pipeline of government security seems awfully full, and it appears that rates are not going down, but rather up. And we notice that the primary dealers, which are in charge of distributing securities at auctions, and work closely with the Fed to that end, we notice that their balance sheets are chock-a-block full of US debt. And we notice perhaps that foreign demand is not what it had been. And we'll just step back a little bit and see where things settle. So back in 1973, there was a failed auction of a 20-year bond. It had never been a favorite of the market. It's kind of a redheaded stepchild of the Treasury yield curve. And the auction failed. And the next day, kind of a mystery bidder came in and made sure it did not fail for a second day. And that mystery bidder was generally acknowledged to be the Federal Reserve Bank of New York. But what happens if there's a failed auction in the context of an inflation problem? Would the Fed be as ready to come in and pour money on the problem as it was in 1973? Of course, in 1973, we could certainly see in retrospect there was a mighty inflation problem brewing, and indeed, to a great extent, already present. But the United States has been rather lackadaisical with respect to its public finances and its public credit. So that's a kind of a foundational concern that I think that the country faces. And there's a lot of talk now about the deficit and the public debt, and Doge wants to do something about it, and President Trump says he wants to do something about it. But notice nobody said nothing about it. Nobody said nothing about it during the campaign. Neither Kamala Harris nor Trump nor the public, as we heard it speak. Every other issue except the deficit and the debt seemed to be fodder for discussion. But maybe the world is going to demand a better accounting by America of its habitual consumption of the pattern in which it produces much less than it consumes. That's what a trade deficit is about. So we run deficits in trade, deficits in current account trade, we have deficit in net current investment, and of course, deficits in the federal budget. And right now, of course, the dollar is flying, and that's the least of the concerns of the marketplace, that these concerns might result in a run on the dollar. But who knows? I think the arithmetic of American public finance, it's not encouraging.
The arithmetic of American public finance is not encouraging. You have such a great way of putting it all, Jim. Let me ask you this question if I can, because it came to mind as you were talking. I just happened this week to have also interviewed Nouriel Roubini, who I think has a somewhat similar outlook to you in terms of what's going to happen with bond yields. And in his advice, he says, if you're running a portfolio where you've got, a standard bond allocation, say like a 60-40 portfolio, his advice is you might want to start thinking about other defensive assets to put in there besides bonds, right? One of the things he said is, he said, short-term treasuries, probably good, right? And to your point that, you get to keep reinvesting at higher yields if that's the direction that things go. I didn't get too much into this with him, but I got the sense that gold was also something that he would be increasingly in favor for, given this outlook. And I'm wondering if you feel the same thing, because it's a way to add some defensiveness to your portfolio, but it's something that as inflation concerns manifest, interest rates go higher, gold should actually, in theory, perform better than, say, a long duration US Treasury bond. Do you have sort of a similar take?
Similar, yes. I think I certainly gold is long-term favor here. I think we were bearish on gold once for 6 weeks in 1985.
Okay.
Or something. So yeah, it's a rather tiresome voice, predictable voice on that. Gold, we like gold because we consider it money, and like so it's a very familiar story. But there's other thoughts on this too. Gold is fine, more than fine, we think. But for listeners and viewers who need income, it doesn't provide any. And
Right.
I love a quote from the great American economist Irving Fisher, who said, if I can do this justice, uh, uh, capital assets are merely the means to the end of a thing called income. So I dare say many viewers of this program would say, yeah, gold is lovely. What does it pay? It does not pay. It's because it is money. We think it's money, therefore it is sterile with respect to it doesn't pay. It doesn't have it. It's like the only way in which resembles Bitcoin is it has no PE ratio, no book value, no dividend yield. So what do you do? So there are Treasury protected, inflation protected securities, TIPS.
Tips. Yep.
And I would be happy to send you for dissemination to any one of your readers, or sorry, your viewers who would like to see it, a piece we did on TIPS not so long ago. I think it was a very good piece. It explained everything, how the yield is calculated. The inflation protection goes to the principal, which increases with inflation, not to the interest rate. So you earn the same interest rate on a greater sum of principal. That's the essential mechanism in TIPS. And there's a tax problem, a small tax problem with that. The government kind of taxes you on its own monetary depreciation, which is annoying but not dispositive. But rather, here's the essential bullish pitch on TIPS. With all of that, the bearish consideration to one side, TIPS are now priced to deliver a positive return, break-even return of 2.4% over the course of 29 years. That's above the inflation rate. Now, 2.41. Now consider that there's only been like 30 years in recent American history in which the inflation rate was less than that. I think 1930 to 1960. That's the only 30-year period, which of course includes the Great Depression, in which there's inflation, a rolling rate of inflation of less than that. So you're basically getting a very good opportunity to earn something, to be protected against inflation by the market's assumption that the inflation will revert to the Fed's chosen level of 2%. And if it does not, TIPS, I think, are a very satisfactory investment, and they're priced now attractively, long-dated TIPS. So as I say, if anyone wants to read what we had to say, the headline over the piece is Bargain Basement TIPS, and that's from late last fall. So just say the word.
All right. Well, let me say the word right now. So, Jim, if you can send that to me, or have your team send it to me after this interview, folks, what I'll do is I will link to that report in my write-up for this interview that will go out on my Substack, and I'll put this on the free Substack so anybody, can
Great.
go read it for free. Thank you for offering that. So that makes a ton of sense. I'm so glad you brought that up. Let me just go back to one part of my point about gold and whatnot, and any other assets you might want to put in this sort of other defensive assets to own. Where if bonds are going to be in a very prolonged bear market, as you think, you would expect over time, some material percentage of what is currently allocated to bonds is going to find its way into these other assets because they're going to look more attractive on a relative basis. And so, yes, we could talk about all the ways in which gold might have a lot of tailwinds for it already, but this may be another one, which is just that a bond investor might say, or a person who's got a fair amount of allocation to bonds just might say, you know what, bonds aren't looking so good when I look out for the next decade. So maybe I'll take 5% of this and put that in gold, right? So there'd just be capital inflows coming from general bonds.
Yes.
Do you think that that will happen?
I guess, I mean, but somebody else is going to buy the bonds, right? I'm not sure if there's so that um, the bonds will go into different hands, but it's not as if money is new money. If there's no new money, right? Anyways, it's a reallocation within the world of invested funds.
True. Although bonds would go into other hands at a lower price, presumably,
Correct.
right?
Right. Uh, I mean, I've owned gold literally for decades, and I've seen it. Um, I've seen it go up, but it is not so volatile. It's not anywhere close to the volatility of, say, Bitcoin. Nothing like that. But still, it is volatile enough
Mm-hmm.
to occasionally break your heart if you are too wedded to it.
Yeah. Yeah. Or if you are dependent upon it moving in the direction you want in a short period of time.
Yeah, for say like paying the rent or something. There's a
Right. Yeah.
um, so um, yes. So uh, gold is great. However, it's not going to help you with the income needs of your family on a short-term basis. We just published an issue of grants that looked at some of the more obscure um, issues in the municipal bond market.
Mm-hmm.
Looked at uh, issues of small colleges, for example, that seem to be well secured and are yielding on a tax exempt basis 5 and 6%. And there are investment managers out there who make a specialty of looking into the unexplored, but mainly unexplored reaches of this. This is 50,000 issuers in municipal finance. There are $2 trillion worth of bonds outstanding. And there are things to do in that realm of the world. And within that big market, there are pockets of value neglected. So that's another thought. I'm not.
No, it's a great point. Actually, if you don't mind, there's a fellow I've interviewed on this channel a couple of times, a guy named Stephen Bavaria, who has his own framework he's created. He calls it the income factory, but it's basically income investing, right? And one of the nice things about bonds is, it's math, right? And so when you're owning a bond or an income generating instrument like this, you have the existential risk of the company, right? Company goes out of business, maybe you're not going to get all your money. You will be a senior creditor, but maybe you won't get all your money. But you have that same risk when you own a stock, the existential risk of the company. When you own a stock as well, you have a bunch of other risks in there as well, right? You've got the enterprise risk, you've got the market risk, you've got all these other risks on top of it, right? And the reason I'm giving you this background is if we're entering this prolonged period where yields are going to go higher and higher, to your point, is it going to be maybe a golden era for the income investor? Which is that, as your contracts mature, you get to reinvest them at higher and higher rates
I'm
over
not,
time.
not sure. That's essentially my point. I think again, depends on the tempo of rise. Even for example, let's go back to the bond bear market. Um, I remember so well 1980, 81, 82, 84. Um, at the worst of that, you saw bonds losing 10 and 12 and 14 points in a year,
Ooh.
but that was just the coupon income. You earned that in the coupon. Now,
Oh,
There's nothing like that cushion now because of the low absolute level of rates. But this is by way of a silver lining rather than a positive attribute. It's not a trivial silver lining. The fact that you are able to reinvest at higher rates. If you invest in a 2-year note, for example, in the Treasury, and then reinvest it again and reinvest it again, you're looking at higher levels of income on not much principal risk. So, yeah, I think that's someplace to explore. Income being as important as it is.
Okay, well, great. One of the things that we want to try to do here is give people a good sense of where they can go to, prudently grow their wealth, even if the
And of
playbook
course,
is changing.
dividend paying stocks, needless to say, although I just said it.
All right, Jim. Well, so on the point of stocks there, I know we don't know the trajectory. We can't really call the magnitude or the timing with much exactitude. But your best guess, just asking you to speculate here, as Wall Street begins to wake up to the fact, if your outlook indeed proves correct, that it's a new world order here. Do you think today's especially on the stock side, but today's market valuations can survive the transition, in some sort of orderly way? Or do you think it's going to be more of a disruptive repricing?
Well, my interest as a journalist, of course, is in good copy, meaning chaos. Um, but apart from that, I think that disorderly would be the order of the day if rates persisted higher in a way that is utterly unexpected and unscripted. But you asked earlier, indeed, at first about the world, which I flew off, but the world has, not only has it got a lot of people, not only is it a big place, but it's got a lot of stocks. And American exceptionalism is a doctrine that has come so easily to the lips of the cheerleaders of the great US bull market that we are sometimes forgetful of the fact that there are worthy, strong, and much cheaper valuation companies valued much more cheaply outside the 50 states. And, so President Trump is I'm not sure he's the most venal president ever to occupy the White House, but he's certainly the one who has an opportunity with a given lever of venality to express that money getting urge with social media and digital technology.
Mhm.
He is now going to offer exchange traded funds, we read, that project his own vision of the future of this country. And you've heard about DEI investing. That is ostensibly over on the left. However, now on the right, there's a whole new school of DEI investing called patriot investing. Yeah, stocks made in America, stocks made for the patriot, stocks made for MAGA. So it was Duke Ellington who said there are only two kinds of music, good and the other kind. Similarly, with equities, good and the other kind. There ain't nothing special about patriot stocks. We want good ones, and sometimes they're available abroad. So it would not be unlike the puckish Mr. Market to have timed a change in the uh, in the relative attraction and relative performance of U.S. equities versus foreign equities on the day of the inauguration of President Trump. So far in this very young new year, European equities have outperformed, and perhaps that is meant to stop today, but they were valued, have been valued by almost half of the U.S. PE multiple. And everyone knows that Europe is an outdoor museum. But nothing is permanent, and nothing in finance, investment. And this is a long-winded way of saying, as to equities, maybe the baton is going to be passed abroad, and maybe the place to be looking is good companies at good prices in different places.
So, what I hear you saying, and I've heard echoed by several other folks I've interviewed here, is that uh, you know sometimes what was it? Price is what you pay, value is what you get. And at some low price, you know an opportunity becomes a great value. And a lot of people are saying in many parts of the rest of the world, they underperformed America for good reasons over the past bunch of years, but are now getting down into kind of deep value territory. And same thing in America, where there's some great companies here, but the current prices they're trading at maybe just don't make them a very good value.
Yeah. I think that's absolutely correct, and it's a wonderful frame of reference for investigating investment opportunities. Um, uh, I think the world has grown very weary of predictions that value will at last have its day.
Hmm.
But I think that it would be extraordinary if the protocols of looking for companies underpriced with regard to their uh, apparent intrinsic value, if that ever became something you shouldn't do, you know, why should that be something not to do? Because it hasn't worked. That what they say about past performance. Well, the predictions of it working again, I must say, are rather, as I say, rather tiresome to the ear. But some of us don't give up easily.
Well, once we clock off here, the gentleman from New Harbor Financial are going to come on, and you've done a great job of kind of teeing up the ball for them because, what you take from what you're saying, Jim, is active investing is likely to come back into vogue here because that's what's going to be needed. Is you're not going to be able to ride the passive trends as much as you've been able to in the status quo, which is now ending, right? Um, and uh, well, so yeah, on that general point, yeah, I'm sorry, Jim. I had a great point that I was going to make, and it just fell out of my brain. Uh, what was I going to say? We've got active investing. Oh, that's what it was. That's what it was. Cut AT freeze. Okay. Three, two, one. Um, so, Jim, assuming for a moment you're right, in one man's opinion, I think you will be proven right. I think the old school rules will eventually matter again. Um, what's interesting is, just looking at the folks that are watching this video, if there's a millennial or a Gen Z watching this video, those rules largely haven't applied in their lifetimes. Like investors are going to have to relearn the old playbook here. And in many ways, we've got a base of not even just retail investors, but professional investors.
No, if I may, I'd like to. So here's a thought for younger people who have tend to do their banking outside the federally insured banking system, and who keep cash balances, significant cash balances on these payments platforms, of which there are dozens. In the event of a bankruptcy or run on one or more of them and trouble among many of them, here's what's not going to happen. The FDIC is not going to come in, swoop in, and declare that after the passage of 24 hours, everything is fine because it has it under control. That won't happen. What is likely to happen instead is a long drawn out corporate bankruptcy in which the claims of the depositors on these lending platforms will not be first. And the corporate bankruptcy could drag on for months, years. It's happened. And I think this is a risk for people who have grown kind of complacent about the nature of shadow banking and so decentralized finance. It's all sounds so winning, and it's faster and it's more efficient. However, there is the risk of just of losing your money or having it locked up for a very long inconveniently long time. And just be aware of that.
That's a great point. And we've seen this movie before on both sides, right? So we had, Silicon Valley Bank and some other banks get in trouble. And what happened? The Fed and the Treasury locked arms, came up and said, look, we're backing every deposit across the country right now, right? And the Fed, it's a coalition of banks, so it's out there to protect its own. Not the case in crypto. And so, you're basically saying, it's going to be less Silicon Valley Bank and it's going to be more like Mount Gox, right? Which is
Just to make sure that I'm not in the habit of telling people what they ought to do, because I'm not sure my advice on that score is what is very valuable. However, in this case, there's a book by Dan Alray, Cornell University law professor, Beyond Banks, I think. He makes these arguments very cogently. But all these years of decentralized finance coming into the fore, and the technology improving, and the technology in the old stodgy, dumb, big banks not improving. There's been a movement away on the part of young people towards the attractive new places. And those places often have names that you might see painted in the back of a sailboat, the stern of a sailboat, these punchy names, and it's meant to be, they're meant to be welcoming, and they're meant to be inclusive and meant to build a community. Great. But they're not. It's like a little car in a big crash. It's not where you want to be. You want to be in that big, ugly, gas guzzling, towering SUV, like the one called Bank America, the one you can't stand.
That's a great analogy. Yeah, it's like a small car in a big crash. All right. Well, fascinating. Jim, I could talk with you for hours as always. I hate to do this, but I promised your team I'd be respectful of your time here. We're coming up on the hour. Is there, we talked about some strategies, some assets to think of in a world of higher for much longer. Beyond what we've already talked about, T-bills, gold, tips, some of these income generating assets like, the tax exempt safe munis and stuff like that. Looking at stocks outside of the US that have been beaten down but are, have good prospects. Are there any other strategies or just parting bits of counsel you'd like to give to today's investors that are just trying to navigate this new world?
Donald Trump is the avatar of volatility. He's volatility on 2 feet. And the measured volatility of the stock market, the implied volatility, is very low. And I think that whether you like the president's agenda or not, just keep aware that what he is in business to do is to disrupt. I just finished writing the current page one story, the current issue of grants. I likened the present day, the first 3 weeks of the Trump administration with the first 100 days of the New Deal. And there's so many similarities, disruption. One case, the right's hair was on fire. That was 1933. And now the left is losing its mind, and uncertainty. And so I think that from all of this is going to come volatile price action, and therefore opportunity. And I think just be prepared to consider a change in regime, of investing regime. So it's a little bit. It's rather a handful of water I have handed you. But we talked about all these specific things before, right? So this is a conceptual thing. Is to consider what a new world might look like, and then to some reason you can't have a little extra research. I mean, so circumspection is not really the strong suit of the president, right? So it falls to individuals perhaps to become more circumspect And in financial terms, that means holding a little extra in reserve for
Mhm.
opportunities that volatility might serve up. And there's nothing like having cash when few others have chosen to keep it. Nothing like that. What a feeling of smugness you can walk around with. Not to mention the things you can find to buy that no one else can afford to buy. So
Right, right. And also just a tremendous amount of peace of mind and relief too. Yeah,
yeah, yeah.
they've proven right. Well, very well said, Jim. It's always such a pleasure to talk with you. For folks that would like to follow you and your work, where should they go?
Oh, I can just ask Mr. Google for Grant's Interest Rate Observer, and you can see a couple of samples of issues of grants, and we'd be happy to have you. I don't think we've run out of subscriptions yet. I'll have to check with the back office. I think we have some subscriptions still available. In the
Still have
meantime,
a couple left over?
yeah,
Okay, good,
in the
good.
meantime, I do invite people to check in on the tips essay I'm going to send you for them. I think it's a good sample of what we do, and I think the opportunity is not it's not like hey, you want to buy Nvidia now that it's $2 a share. No, it's not that, but it's an income producing security at a time of perhaps persistent inflation. That's all. That's
All
all.
right. Well, thank you so much for writing it and then for making it available to this audience. And folks, I realized I forgot to mention the URL where you can go get that for free. And so that's thoughtfulmoney.substack.com. Go there, look for this write-up with Jim, and it'll be linked to within that write-up. Jim, my friend, such a pleasure. Thank you so
Oh,
much.
thank you. I'm glad glad I know you.
All right, well, now's the time of the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by Mike Preston and John Loder. Gentlemen, thanks so much for joining us. Let's see, Mike, why don't we start with you? Let's get your key reaction to the discussion there with Jim, and then we'll talk about some of the things the market's up to.
Hey, Adam, thank you. Real good talk by Jim Grant. And I got to tell you, the way that he answered your opening question really impressed me. You always ask, what is your take on the global economy and financial markets? And essentially, Jim said, I don't know. It's not clear. And for a man that's been such a legend as Jim Grant, that's been in this business for decades, to come out and say, I don't know, you just got to love it, because the truth is nobody knows. We all have opinions. And that's the key here. We are all earnestly sharing our opinions, but it's up to each individual, each viewer that you've got to take this information and assimilate it into their own situation and then make decisions with that. And of course, we and others are happy to offer our advice and guidance, and that's what we do. But nobody knows for sure the future. So it's really murky, particularly now. And particularly if you think that we're in a time of higher risk, a fourth turning for the people that follow that theory. Nobody really knows for sure. What we do know is that a lot of things are likely going to change and that things are likely to be a lot more volatile and risky in the next few years than they have been in the last few years. And so Jim said that too. Expect a lot more volatility. Expect active investment to outperform passive investment. At these valuations, you can't expect to just invest in the S&P 500 or any other major index and get positive returns in the years ahead. So I heard that pretty loud and clear. The other thing I heard loud and clear from Jim is that he thinks inflation is going to be higher for longer, higher and stickier for longer, much longer, is what he
Much,
said.
much, much longer, I think is what he said. Yeah.
Yeah, and he talked about 2020, 2021 being the end of this long 40-year bull market and in the beginning of a bear market. And he said the market in bonds is likely to trend. Now, maybe I disagree a little bit with Jim on the exact path, but again, nobody knows for sure. I actually expect that we might see sometime this year some equity market weakness or worse, followed by a much more rapid reversion to lower interest rates, particularly with the Fed probably going back to the same tools they've always used, that being lowering near-term interest rates. I think we might actually see yields go down. In response to an asset price crash. But then later on, I think that it's true that we're going to have higher yields for longer. But that is our guess. That's basically our call based on the data. Jim came out and said, I think it's going to be higher for much longer. He didn't say that he saw a dip. So, maybe we disagree on that, but I think that overall, we agree with Jim that the average rate on corporate bonds since 1790 has been around 5 to 6%. Um, and U.S. bonds are a little less than that, but they're close. And that the current rate of the 10-year bond at 4.6, I guess, as we're speaking, is not that high. It's not different from the norm. In fact, it might even be slightly less than the norm. So, don't necessarily expect that rates are going to go back down at least permanently, though I wouldn't be surprised if we saw a dip down at least first after an equity market drop, and then
Yeah, and
maybe
Mike,
a reversion
I
higher.
didn't ask Jim specifically about that, but my take from Jim was he's looking at the long arc when I was asking about the future direction of bond yields, and so he's looking out decades. I'm
Yep.
sure he would probably say, "Hey, look, it's not just going to be a straight line. There's going to be periods of corrections and dips and stuff like that." So I just I don't want to I certainly wouldn't want to put words in Jim's mouth, but I think he would probably say, "Sure, I could see a short-term rescue action from the central planners in response to a weakening market, and that could bring rates down for some period of time. But then, like you, they'd probably drift up over time." Um, I don't want to get sidetracked on this, but just to let you know, if you're thinking, wow, return to kind of forever, 5% plus bond yields sounds a little aggressive. Uh, my interview with Nuri Rubini, which you guys haven't seen yet on the day we're recording this, but it will have been out a couple of days once this video goes live. Um, he predicts that bond yields will get up to 8% by 2030, so by the end of this decade, not too far from now. And yeah, I know that catches your attention there, Mike. I saw your eyebrows go up. But then he then he predicts by 2045, so 20 years from now, he thinks that US GDP could be growing at 8%. He thinks because of technology and whatnot that growth could go exponential. So that sounds kind of crazy. But he thinks that 8% growth, while it sounds great, is also going to come hand in hand with 80% unemployment. And I know you guys haven't watched that yet. We don't need to really get into it. And believe it or not, he knows that's like a very extreme prediction. He says, but I believe that's where we're going to go. I just bring it up here to say that some other people have some potentially outlandish predictions like that make going back to a 5% average bond yield actually seem pretty darn tame.
Yeah, I mean, it's th those are big picture predictions, and none of that happens, I don't think, without some pain along the way. Certainly,
Yeah.
80% unemployment is painful. I mean, we can't even imagine that. I
Yeah,
think that on
again, I won't get into it. In that world, he sort of thinks, your UBI has got to play a factor and all that, all the people displaced by AI and all that type of stuff. And again, I don't want to make you guys have to defend or react to that, except just to say, Jim thinking we could go back to 5% average bond yields or higher, it's not the craziest prediction in the world.
No, and I think that the key is you don't have to know the exact path. I think the key to know is that we are at a time of high risk, and a lot of very unpredictable and probably scary things are likely to happen, particularly in the climactic part of this fourth turning that we're living through. So, we're here to guide people step by step, day by day, month by month, and year by year. Would not be surprised if we saw some type of you know, really bad market scenario after we peak here. I wouldn't be surprised to see the market dip into a bear market and stay there for years, and if that happens, a lot of other bad things are going to happen. So, a lot of times people think investing is a static thing. I've got to make a choice now and leave it, leave this asset allocation for the next 20 or 30 years. Maybe some people do have to think like that. Certainly, if you're an institution, you've got to think like that. But if you're an individual, if you're a relatively small, mid-sized money manager like we are, we have the ability to be more active and more tactical. And I think that there's a tactical trade in bonds, frankly, here. Even though Jim Grant thinks that inflation's here and it's here for longer than we expect, I think that between now and 2 years from now, there is a trade to be had in long-term bonds, as we would expect rates to dip a little bit, as I talked about earlier. But long term, if you have to buy something and hold it here for 20 years, I wouldn't be buying bonds, unless maybe you consider tips. Jim talked a lot about Treasury inflation protected securities, and he was saying they're pricing at around 2%. I'm sorry, he said, frankly, what he said is that if inflation doesn't revert to the 2% target, then these are good deals. They're actually pricing in higher than 2% inflation, something like, I think, 2.6 or something like that over 10 years. I'd have to take a look at the latest numbers. And he also said that gold has been a good store of value. He conceded that gold doesn't pay income, but there's some ways, I think, that you can get income from gold. You certainly could do some option strategies or option selling strategies on paper gold. You can get creative if you're skilled, or talk to an advisor that can help you out with that. But overall, I think that there's a lot of crazy things that are likely to happen over the next 5 or 10 years, and maybe even over the next 2 or 3 years. And we'll be here to help people figure it out.
No, all right. Well, if we can, let's really narrow the beam, not years out in the future, but what might be happening here, in the next couple of weeks, maybe months. Before we turn the camera on, we were talking, guys, how the market here, S&P in particular, sort of seems to be coiling. It's stuck in a trading range, and usually what happens is it'll do that until it gets enough compression that it breaks either above or below that range decisively. So, John, why don't we go to you here? Do you want to comment on how you guys are watching the markets right now?
Yeah, absolutely. So I'll remind what Mike just also reminded folks here. We forget about the big bombastic headlines. It really doesn't. You don't need to forecast the big, huge headline grabbing numbers to deduce from the standpoint of most typical everyday folks that are worried about their financial security, their ability to create their own paycheck from their nest egg during retirement. You don't have to look to big headlines. In fact, you're well advised not to look to big headlines to properly plot your course. What we can say with very strong conviction and zooming out is that we are in a very richly valued stock market. We are in a market that is still grappling with a return to some normalcy of interest rates. What feels like extreme interest rates right now is really quite normal in the broad, expansive history, and that's something that Jim Grant pointed out. So there is every good reason beyond the headlines to be very careful and very conscientious about one's allocation. Underweight equities, we believe still underweight bonds, and we'll talk about some of the things there. Let me just share a couple charts, because at the end of the day, we are looking after the day-to-day for our clients. Rarely are there day-to-day moves that need to be paid attention to, but it's a series of trends and action in the markets that lead us to make tactical changes for clients. And not every client is the same. I will tell you that in recent weeks, we've had, I can say I personally, and I know my teammates have had one-to-one conversations with clients where they have shared some individual concerns that make every sense to express in a kind of a unique expression in their portfolio, whether it's a leaning more conservative, leaning more aggressive, whatever the case might be. We can cater our core discipline to clients and meet them where they are, and where they are in their life and their ability to sleep at night, and all the kinds of things that make for the wholesome relationship that we have with clients. But let me share a couple of charts. Let's talk about the market. I'm going to share a chart of the S&P 500. This is the swoon we had back in August, and we've charged pretty steadily higher, but we've been basing out here in recent weeks. And ever since the inauguration in mid-January, we've been kind of having this slow drip down, and we've had these big news Mondays, sell-offs on Mondays. You see, we've had a couple of successive what we call bearish engulfing candles on these daily charts. So we are seeing a market that's starting to look a little heavy. So that's definitely something we're very mindful of. Okay. We're only about 42% or so in equity exposure for clients. This horizontal line here at 5,700, that is where we have some insurance protection, some put option protection for clients that would take off the risk table about 15% of client portfolio allocation to equity. So if we did get a resumption down here and started to take out this kind of critical support level, almost like a light switch, we'd be peeling off about 15% equity exposure. So we have defenses in place, and we're watching things very closely. I would like to kind of turn to interest rates a little bit. I'm a visual person, maybe some of your viewers are. And I want to kind of look at a long-term picture of interest rates. Hopefully you can see this okay. So the blue line is the 10-year Treasury, US Treasury note yield, and the black line is the federal funds effective rate. The black line is what the Fed controls in the very short term. The market really controls the blue line. And you can see here, even though the recent headlines have been scary about interest rates, we're right here when in the long expansive history, we've had much higher interest rates. You might say we're just back to normal here. The last decade plus has been conditioned, as Jim mentioned, folks, being brainwashed into thinking that the Fed is always there to rescue markets. The Fed will come and institute quantitative easing at the first instance of any market reaction. Just this week, Chair Powell said pretty emphatically that he doesn't view QE even being a tool to be even considered until and unless short-term interest rates get back down to zero. So whether that's just sound bites or truly the reflection of the thinking of the Fed, that says a lot. We'd have to see some major market damage before things like QE start to come back into play. Now, we have little doubt that there's a pretty good probability that market damage will happen, but we've got a long way to go before then, and it can come really out of nowhere. We have an environment here where things are pretty dicey. Let me just show you the reaction to interest rates here today. So here's a chart of the 10-year Treasury note yield. This is a daily chart. You can see we've been having this, channel downtrend in yields in recent weeks. Okay, today's inflation report caused a massive spike out of that downtrend. We'll see if that sticks, but this is, in the very short term, that's not a very encouraging sign. And it really gets back down to market expectations about inflation. This is what the market has been pricing in terms of inflation for the last, several months. Was right here is where the Fed first cut interest rates by 50 basis points. This is the market's expectation of inflation over the next 5 years. It's steadily risen. And right up through today, that expectation has steadily risen. So whether the market gets it right or wrong, we'll see. But it doesn't much matter. The market's going to do what the market's going to do, and it's going to manifest itself in the action of prices. One last thing I'll call out here before we give it a pause here. This is the market expectation for Fed interest rates over the coming couple of years. Notably, the central most probable scenario that the market's pricing is this blue column. So they're pricing in a single cut at the October 2025 meeting, so several months before a cut, and then they don't price in another cut until December of 2026. So in other words, one cut and then pause for a real long time. That will change, and in fact, this has been very noisy, but it says something that's what the market is pricing into the future at this moment in time.
Yeah, and it's interesting that we've had such a massive shift in inflation expectations, and the market for the past couple of years has been just chomping at the bit for the Fed to come to the rescue, and now the Fed is, market's now basically realizing the Fed's probably not going to do much more on the rescue side for a good long while, and yet we're still hovering near all-time highs. So as you said, we're seeing some technical signs that the market could be becoming a little top heavy, but too early to really have a lot of confidence in that thesis here. So I don't know. I mean, I guess it's sort of what makes your job a little tough, right? Which is, what do you go with? Do you go with the momentum, or do you go with the fact that maybe the market's waking up to the fact that the game might be changing a little bit? I asked Jim that directly. Of course, we weren't talking about the next couple of weeks, but I asked him, do you think if once the market wakes up to this, will it be sort of a gradually managed transition to the New World Order, or will it be some sort of disruptive repricing? And he basically said, I think it's probably going to be pretty disruptive.
Yeah.
Way too early to say that we're there right now, but you look at that and you just say, gosh, we really haven't seen any adjustment in market prices yet for this big shift.
Yep. And Adam, and that's why it makes sense to zoom back out. In fact, I want to share one more chart because Jim talked about the 70s and the inflation there. And, honestly, one of the first casualties in an inflationary environment that is sticky, and it seems like we're in that sticky inflation environment, at least based upon readings that we've been seeing. You can go back to the 70s and you can see it was a horrible period for most financial assets. Stocks did horrible, bonds did horribly. They both lost value on an inflation adjusted basis. Things like commodities and gold did well, but it was a very, very tough time to be a passive investor. I'll share a chart here that shows the market, the stock market in the 70s. The top pane is the CPI. So the 70s were defined by two, repeated bouts with inflation. The second one even worse than the first. And you can see here, as inflation started to peak, markets started to sell off pretty dramatically. So this is the 73, 74 bear market. This is when inflation really started to, cause concerns, and the lofty valuations in the stock market then were first met by a huge sell-off here, in the stock market. Now, if you passively held through that, you basically went nowhere. You lost money through the 70s. But if you tactically were underweight equities here and were shifted back in here, you had the opportunity to do quite well. And that's very much the hallmark of what we think is likely to be a very well-served strategy in the years ahead. Passive, we think, is going to be very challenged for these big macro headwinds that we think are not just temporary facets of the market, but are really entrenched and are going to be pretty tough navigating here as the years unfold.
And as I talked about with Jim, so he would agree that the active approach is probably going to be forced on investors going forward. We've got so much of the embedded base of investors right now that only know the passive playbook, right? So they're going to have to be sort of shaken out of that habit. And then we have a huge part of today's investors that are really not investors. They're speculators. They're hugely piled into these assets that really can't be described as anything else than highly speculative vehicles right now. And the reason why is because that has worked to a certain extent. And then you also have the societal, especially amongst younger investors. Hey, I'm not going to be able to afford the American dream unless I get one of these rocket ride, meme stocks or crypto tokens or MicroStrategy, leverage MicroStrategy ETFs or whatever, right? And if we have the kind of environment that you think we're going to be heading into, John, that's highly likely to kind of zorch those asset classes, and people are going to, as Jim said, maybe finally get their hands burned enough to return back to the old fundamentals-based way of investing. All right. Well, look, it's just beginning to wrap up here, gentlemen. So Jim and I talked a bit about gold. John, you just mentioned that as one of the assets that did well during that analog period in the 70s. Mike, you usually give us an update on gold when it's doing something interesting, and gold actually has been doing something interesting recently. And not just gold as well, right? The gold mining stocks too.
Yeah, I mean, looking at the gold chart, if you count, straight up 45-degree angle lately as interesting, it certainly has been doing something interesting. The gold chart itself has been pretty relentlessly up, and it's trading just above 2,900 here. It looks like around 2,905 on the spot market. We had a little bit of a breather yesterday, but it's been pretty much super strong. And it's broken out of a nice base. And we've talked for a long time here on this program about the underperformance of gold miners, but that's starting to change. And based on the tools that we use, and we try to use criteria that aren't too sensitive, because if you keep playing with technical indicators, you can kind of make things look however you want them to look. So we try to use indicators and charts and all kinds of comparisons to take a look at what statistically significant changes are. And just today, mining stocks have reversed up in relative strength versus bullion. And for a long time, that's been the opposite. Gold has outperformed gold miners. And now over the last few months, I could say, last few weeks to few months, gold stocks have demonstrably outperformed gold. If you take a look at gold stocks right now, gold stocks today are up about 2.4%, and gold is relatively flat, up about 0.2%. So we're starting to see a catch up of gold stocks. And I guess I'll just share a quick chart just to complete the update, and then I'll stop there. So here's a chart of gold stocks. This happens to be GDX, and you can see a nice bullish engulfing pattern today. We're coming back to this old high of 43 to 44. So I can tell you when the gold stocks broke down at the end of last year, December was not a good month for gold stocks. It was really disheartening, for us and for all kinds of people that have been gold stocks, because during the same time gold was going up. But we have just been ripping up these last few weeks. Let me change it to a weekly chart. Take a look at that. Take a look at what gold stocks did. It was broke down to almost broke support, and then it looks like by my count, this is the seventh straight week up. And so even though we're back to where we were back in October, it's not really the same because this pullback kind of was the pause that refreshes. And if we break out of here, we can go a bit further. So that's what gold stocks are doing. And going to a gold chart, this is what gold has been doing over the last 7 weeks. So it's been straight up. This is a little kind of cup consolidation. We broke out of that, and we are starting to get stretched, as we admitted last week on this program. But instead of trying to time the top, which is often not easy to do, as long as your position is set and it's within reasonable size, just let it work. And so all of this is happening, by the way, when the dollar has been relatively strong. So the dollar here, I know it's been going sideways for a few months, but the last since September, the dollar has been on a big tear higher, sitting here at around 108. And so gold has been doing well even with that. Gold stocks are starting to outperform. And, gold here at 2,900, the charts say we should hit 32 to 3,400, and hopefully before too long. So we'll see.
All right, Mike. Well, look, there's a lot of gold owners that watch this channel that I'm sure are hoping you're right in that prediction for where gold prices might go relatively soon. Let me ask you this. You and John have talked many times on this program in the past about your approach in using options as hedges on your portfolio there at New Harbor. When you have a kind of a runaway period, like it seems like we're having right now in gold and gold mining stocks, are you using this as an opportunity to raise your hedges there so that you're getting a higher price? So in case there is a pullback, your protection kicks in at a higher price?
Yeah, there's a number of details that probably beyond what I can answer here, but absolutely, particularly if you get a rise in price and then a sideways movement or a pullback, when you're a seller of options like we often are, not always on gold mining stocks. A lot of times we use collars, but for most of what we do, we sell premium, and you get time decay working on your side, and invariably there's pullbacks, and so you can use those pullbacks to reset your hedges. Right now, I'll admit that we're in a spot where we're going to have to watch very closely, and we have GDX and we have hedges at 43, at the 43 level, and the chart I just showed that GDX was just over 42. So that's okay because we're getting into the area though where our hedges will actually become a little bit underwater. If we go through that 43 roof or ceiling, we're going to have to adjust those hedges, and we're going to have to watch the time value component of those options that we sold. And so all of that is to say you have to manage these things. You've got to manage them actively. And other things we can do is adjust the position size, and we can up our mining position relative to the bullion position, and we might very well do that because of the relative strength positive signal that we just saw. So, and lastly, I should say, if we get a real breakout that looks like it's got legs, we might actually relax our hedges altogether and not worry about being 100% hedged.
All right. Well, look, folks, if some of that sounded a little bit like Greek to you, I highly recommend you go check out the instructional video that Mike and John recorded for the Thoughtful Money audience. That's over at thoughtfulmoney.com/hedging. That'll help explain the terminology, but give some examples of how Mike and John and their team there at New Harbor use options to manage downside risk in the way in which we're talking about here. All right, gentlemen. Well, look, thanks so much for joining. It's always wonderful to interview Jim. Thanks for keeping us up to date on what's going on in the markets. Obviously, a lot to be watching closely here, both in terms of where gold goes from here, but that coiling of the market, John, and seeing which way that may break from here. Look, a couple of things as we wrap up here. First, folks, if you really enjoyed having the great Jim Grant on the program, would like to have him come back on again soon, please let him know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. If you want to get the free report on tips that Jim was talking about, just go to thoughtfulmoney.com and click the newsletter link at the top of the website there. That'll take you to our free Substack, and you can go read the write-up that I did of this interview with Jim, and you'll find that report linked to within that. If you want help in figuring out how to position for the road ahead that Jim mentioned here, and some of the outlooks that John and Mike shared with us here, I highly recommend most people watching this get help from a good professional financial advisor. If you don't have one that's already providing that role for you, or you'd like to get a second opinion from one that does take into account all the macro issues we talk about here, maybe even John and Mike themselves there at New Harbor, then consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. To do that, just go again to thoughtfulmoney.com, fill out the form right there on the homepage, and these firms will be in touch with you immediately. And as a reminder, these consultations are totally free. There's no strings attached. There's no commitments expected. It's just a free public service that these folks offer to help as many people as possible, position as prudently as possible for what's coming on. And lastly, again, while you're there at thoughtfulmoney.com, don't forget to go to thoughtfulmoney.com/conference and sign up for our spring online conference if you haven't done so already. Conference is coming along great. The faculty is the best we've ever had. And I know I have to remind folks of this, but don't worry if you can't watch live on the date, which is Saturday, March 15th. Everybody who registers for the conference will be sent replay videos of the entire event, all the presentations, all the Q&A after the event concludes. And if you are a premium subscriber to our Substack, you'll get an additional $50 off the early bird price that we're offering right now. So don't wait, don't walk, run, go buy your ticket now so you can either lock in that lowest early bird price or get an even lower price if you're a premium subscriber. All right, John, Mike, thanks so much, boys. Such a great time with you. Really appreciate you coming in here and making sense of the markets for everybody week after week. Like I said, a lot to monitor. We'll see what next week's brings, but thanks so much for coming on.
Always a pleasure, Adam. Thanks again, and thanks to your viewers.
Had a great time, and thanks, Adam. We'll see you soon.
All right, and everybody else, thanks so much for watching.